Now, based on, I've talked about needing more accommodation. How can the FOMC provide more accommodation? I think there are several possible approaches open to the committee. The committee could reduce the public's level of uncertainty, policy uncertainty, by clarifying the nature of the economic conditions that would lead the committee to reduce or stop its current asset purchases. As I mentioned earlier, the committee is buying $85 billion per month. What would lead it to stop or reduce that flow of purchases? Alternatively, the committee could communicate to the public that once we do begin the removal of monetary accommodation, which is still a long ways off, the rate of withdrawal, when it starts to take place, will be slower than is currently anticipated. Both of these would provide accommodation for the economy, be monetary stimulus. But these are going to require some relatively complex changes in the language of the current communication from the committee. My own preferred approach is simple. In its current forward guidance, as I told you, the FOMC has said it's going to keep the Fed funds rate at extraordinarily low levels until unemployment falls below 6.5%. You can provide additional stimulus by changing that 6.5% number to 5.5%. So it's just changing one number in the current statement. Now, why is changing that one number from 6.5 to 5.5 going to provide more stimulus to the economy? Well, think about two scenarios. One in which the public believes the FOMC will begin raising the Fed funds rate when the unemployment rate hits 6.5. That's consistent with the current guidance. And the other, the public thinks the FOMC will wait till 5.5. A higher unemployment rate in the first scenario means that the public will think that monetary policy is going to be tightened relatively soon. And that's going to in turn lead to the unemployment rate being higher for longer. People are going to have to save more in that scenario to protect themselves against the risk of being unemployed. They save more, they spend less, there's less economic activity. Lowering the unemployment rate threshold to 5.5% would increase the demand for goods and thereby push upward on both employment and prices. So I think the big question, though, about this is, would this extra monetary stimulus result in an undue amount of inflation at some point in the future? And here I find the recent historical evidence to be quite comforting. This is the medium-term inflation outlook coming out of the FOMC. The green portion comes out of what's called the Green Book, which is a staff forecast for inflation that they prepare for FOMC meetings. The SEP is a summary of economic projections. These are based on projections that come out of the principals of the meeting, the FOMC participants, the 19 participants I described earlier. And those projections will only be started being made actually in 2007, which is why we start that picture in 2007. And earlier, those are as I said, the Green Book forecasts are coming out of staff forecasts. If you look at this chart, it documents that the medium-term inflation outlook has never risen above 2.25% in the past 15 years. And this is even though the unemployment rate, as I showed you earlier, was actually at times below 5%, actually closer to 4.5% at times. This historical evidence, to me, suggests that as long as the unemployment rate remains above 5.5%, wage pressures will be sufficiently subdued that the medium-term inflation outlook will stay close to 2%. Okay, so this is using the past, right? to inform our guesses about the future, or our thoughts about the future. But I don't have a picture for this, but the committee's estimates of future long-run unemployment are also consistent with this historical evidence. Most FOMC participants expect over the long run an unemployment rate of between 5.2 and 6% is consistent with inflation of 2%. So that's, we can get to keep unemployment between 5.2 and 6% and not have inflation be different from 2. These estimates suggest that as long as unemployment remains above 5.5%, wage pressures will not be sufficiently strong to generate a medium-term inflation outlook, much in excess of 2%. Now, these are estimates based on what we know now about current labor market conditions. The FOMC's estimates of the unemployment rate consistent with max employment could change over time in response to new information and new analysis. This is why it's so important the FOMC's current forward guidance contains what I see as strong protection against inflation, undue inflation. As I described earlier, that guidance clearly states that the committee's commitment to a low Fed funds rate is off the table if the medium-term inflation outlook ever rises above 2.5%. I've said that I see it as unlikely that this inflation threshold will be breached. It's informed by these kinds of data analysis. Even if the committee were to lower the unemployment rate threshold to 5.5%. But the converse is also true. I would see a breach of this threshold as being a cause for significant concern. We haven't seen a medium-term inflation outlook as high as 2.25% over the past 15 years. In that context, a medium-term inflation outlook of 2.5% or more should be seen as highly unusual. In my view, such an unusually high inflation outlook should lead the FOMC to strongly consider an aggressive response. So to summarize, my outlook for both inflation and unemployment implies that the FOMC should provide more monetary accommodation. In December, the FOMC said that it anticipates keeping the Fed funds rate extraordinarily low at least until the unemployment rate falls below 6.5%. In my view, it would be appropriate for the committee to increase the level of monetary accommodation by lowering the unemployment rate threshold to 5.5%. You might be worried that this will give rise to undue inflationary pressures. I see that possibility as unlikely. And even if I'm wrong in my assessment, the committee's forward guidance provides tight inflation safeguards.